I'm Matt Bishar with Nareit, here in Hollywood, Florida for Nareit's REITwise, the 2018 Law, Accounting, and Finance Conference. Joining me today is Tom Wilkin, partner and U.S. REIT leader with PwC. Tom, thanks so much for joining us.
Thank you.
Now, there's always a lot of talk about cycles in the real estate industry. Based on your experience, where do you think we are in this current real estate cycle?
Well, I think I've been saying this for years. We feel like we're in the late innings given everything that's happened. I think recently there's been some softening in the valuations as a result of rising interest rates and rising cap rates as a result. And I think those really haven't yet been offset by the potential impacts of tax reform and the rising rents that may be a result of that. So I think those two elements coupled, once they start actually hitting, will reverse and offset some of the headwinds from the rising rates.
Now, what are you seeing regarding valuations that might spur either privatization or an increase in IPO activity?
Well, there's a lot of activity happening in the market. Some of it's valuation related to causing new REITs to form, et cetera. Others are transactional and actually tax reform related as a practical matter. I think you're continuing to see a lot of the public to private type transactions that occurred over the last several years. I think that'll continue as the big funds try and place big amounts of capital into the market in acquisition transactions quickly. Those will continue, and I think to some degree they're taking advantage of some arbitrage between the public and private valuations. We're seeing a number of other elements that are coming into play that are causing new formations of REITs. One is the spin-off type transactions, which are either property types being spun off from diversified REITs, geographic focus is being broken down. Those are creating new vehicles that are more targeted and more desirable for the investors. We're continuing to see some of the non-traditional REITs, though there's probably room for IPOs in that sector. Not in too many other sectors, but in that sector in particular, there are some opportunities in some spaces, but the non-traditional players in things like data centers and cell towers and billboards and all of those types of transactions, I think those will probably continue to get play. The final phase is, or the final piece of this increase in REITs is the blurring of the line between the public and private space, the fund space, and the REITs, the sponsors of the funds. You're starting to see them enter the quasi-public REIT market using the new style, non-traditional, non-traded REITs that are really acting like open-ended funds, but they're sold to retail investors and they're registered with the SEC, so they're kind of quasi-public in that regard.
Now, lastly, we've spoken in the past about overhauls to lease accounting standards. How do you see this impacting the commercial real estate and REIT market?
I think what we said last year is still true, and there's an intersection with the tax reform, which I'll come back to. But as far as the direct impacts, there's really not much of a direct impact on most of the REITs because the lessor accounting, landlord accounting has really not been changed all that much. There's some issues on the margin, but not things that'll radically change how people view REITs and their financial statements. I think some of the indirect effects as the lease accounting gets nearer, people are starting to think on the lessee side, the tenant side, how to structure their existing leases differently and potentially modify leases that already exist and potentially change the terms, either shorter leases within a certain degree or the types of leases that they enter into, more net lease, less gross lease type transactions. So you'll see that happening in the market fairly significantly, I think, in the next couple of years where that dynamic will shift. Another issue is spurring a change in what people are doing is tax reform. And the interest rate caps put in on tax reform may actually drive certain users of real estate to reconsider monetization transactions where they're spinning off or selling off assets and leasing them back for use. That has the effect of effectively reducing interest expense because you'll take the proceeds and pay down debt in many cases, and therefore reduce the interest expense and convert it to rent, which is not subject to the cap under tax reform. So perversely, it may actually put more product out into the landlord space in terms of those types of transactions, and that may be a benefit to the industrial REIT players and the net lease players, for example, who are looking for those types of assets.
Tom, thank you so much for joining us.
Thank you.
For more from REITwise, be sure to visit Nareit's website, REIT.com.